Hello and welcome to the next 100 Days podcast. My name is Graham Arrowsmith.
And my name's Kevin Appleby. So, Graham, we're both getting a bit older, aren't we?
We're actually in our guest's sort of target market. He's nowhere near our age, but effectively, he actually helps people in later life finance. And that's his company.
That's something that happens when you're about 95, isn't it?
It is. And we want people, well, not really, but it is. I will probably ask the question. I suspect it's a bit younger than we are now, Kevin. But today, our guest is Paul Murphy from Later Life Finance. Paul, welcome to the next 100 Days podcast.
Thank you very much. Nice to be here.
And for it's mostly we're getting guests from up Newcastle way, etc. But you're actually in God's County, aren't you? You're actually based in Yorkshire.
I am very local.
You're very local. Actually, if one of the aeroplanes skidded off the runway, it'd shatter into your offices, no doubt.
Yeah, I can pretty much see them from the office coming in and out. So we're very close to the runway.
Yeah, probably uncomfortably close, but then again, what can I say? It's a fairly safe. Yeadon Airport's one of those airports that if it's blowy, it's awful coming in because the wings are up and down and it's really scary.
Yeah, they're coming sideways some days.
It's one of those things that you could actually make a little video of it, Paul, and put that out as a sort of social media thing.
That's right.
Get your finances sorted out, otherwise this is what's going to happen to you. You can imagine that. So, Paul, your business is called Later Life Finance. Tell us a little bit more about that.
So we formed the company 8 years ago, and we specialise in later life mortgages, basically, so lifetime and retirement mortgages.
Yeah.
The company was directly authorised by the Financial Conduct Authority last year. So since inception, the company's advised under an AR type structure.
But what does that mean? AR?
Yeah, like an appointed representative under another directly authorised company. So, but because of local growth and national growth, really, we decided to take the company through the direct authorization route last year.
Yeah.
So, and we moved into the offices just over a year ago here. And, it's a small family business, and we're focused on quality advice and looking after people because, lifetime mortgages and that type of lending, obviously there is an older demographic to the products, and we just focus on looking after people for life, really, and ensuring that the best interests are kept at heart. So,
well, Kevin suggested that you have to be really old to be in your target markets, but give us an idea of typically the ages that you start getting interested in people.
55 is the minimum age for the lifetime mortgage. Okay, It depends on the circumstances of the customer. The average customer age may be mid 60s upwards, but it just depends on what, we get people who are getting divorced, we get, people in the mid 50s who just need a remortgage and they might not be working for medical reasons. And the products that we arrange are more flexible than the mainstream mortgages that, the banks offer. In terms of repayments and affordability analysis, there's no mandatory payments to make, so they're easier to set up than the mainstream mortgages.
And a lifetime mortgage, sort of unpack that for us, because does that mean to say that I'm going to be paying until I'm in the floor, sort of thing? Is that the idea?
Yeah, if you took a lifetime mortgage, it would run for the rest of your life. Okay.
Right. So if I'm 63 currently as we record this, I know I look more like 35, but it's one of those burdens. But then again, let's just say then I live to the ripe old age of, say, 93. So it's another 30 years. So what you're saying is that I'd have a mortgage for 30 years. It's a bit like when we were kids.
Yeah. So basically, that if you left it to run, that's how it would work. Okay. So the downside is that if you don't pay any interest back, it gets added on and it's compounded. Okay.
Right.
But a lot of clients now are opting to pay the interest back. So you can actually run them like an interest-only mortgage.
Yeah.
It's not technically an interest-only mortgage, but you can set up a monthly automated payment if you wish. And then you can, if you borrowed a lump sum, you can maintain it at that balance for the rest of your life, or you could stop at any point paying, and then the interest would keep, being added on. But
I see. Okay.
Yeah, the demand for lending in this age group has really been driven by the interest-only mortgages that have been maturing, that from the 1990s with the endowment policies.
Yeah.
And there's 40,000 maturing every year over the next 10, 15 years. And the banks haven't got an answer to that because they don't lend over a certain age group.
I see. So all these reasons that you mentioned earlier, Paul, I'm divorcing, or I don't know what, apart from sort of divorce, just give us a few other reasons that people.
A big one now is gifting an early inheritance, a living inheritance to family. So we get a lot of wealthier clients with inheritance tax planning, taking some of the money out of the property now to enjoy. Even if you haven't got any family, you could use it for yourself for retirement, or if you do have family, you could gift it to family members. And then all manner of reasons, really, anything you can think of. We've had people buying boats, you name it. Yeah. So,
well, I don't suppose there's much. Well, I don't know. You're not going to get very far on Keighley Tarn now, are you? Let's face it. It's a sort of,
or Eden Tarn,
or Eden Tarn even. But exactly, it's a bit blowy up that way. But having said that, you get a mortgage, a lifetime mortgage. What's the sort of average level that you would typically get?
Okay, so the minimum age is 55. You're looking around 20% roughly, depending on the lender. And then that increases by around 1% every year you're older. So if you're in your mid-60s, it'd be around 30%, and it just keeps going. So the older you are, the more you can get, because you're closer to potentially, obviously, passing away in the lender's eyes. That's how they base their funding models. So, that's how it goes.
Okay, so it's 30% of your current property value.
Yeah, based on your age, your current property value. So you retain full ownership. So if the house goes up, or whatever property it is increases over the years in value, that would still benefit your estate for the future. That growth, you only pay back what you've borrowed. And if you've paid the interest back, then your lump sum won't be accumulating like it would if you didn't pay anything back, you see. So you've got more flexibility.
So you take out 30%, and let's do round numbers. You say your average property is, I don't know, up in your area, Kevin, it's probably going to be 500,000. Let's just say 500,000. If it's 500,000, then you've got 30% of that. My maths isn't all that good, but that's what,
150,000, Graham.
I was getting that. 150,000. That 150,000 would have so much interest accruing each month. Current interest rates presumably are.
Yeah, they're currently a little bit higher, up around 6%, because of the recent situation we've had with the mini budget last year, and the effect on the lending markets wasn't great, but they're starting to drop back down again now. So
that would be about, give or take, 7,000 or so in a year.
Yeah, and then the interest would either be accumulating on top of the
of the 150,000, or basically they'd pay that whatever it is, 7,000 divided by 12. They would basically be paying that.
Yeah.
Does it have to be on a variable, or would you fix it in some way?
It's fixed for life with most lenders. So
right.
Yeah. Well,
right. Yeah. So if interest rates went down, Paul, then you'd be basically out of pocket a bit.
Well, over the years, because when I started in the industry nearly 15 years ago, interest rates were around the same level they are at today.
I suppose so. Yeah.
I've had, and over the last 3 or 4 years have been very low, especially following lockdown. The lenders, were trying to stimulate growth with lending. So, they came down pretty low. So over that time frame, I did remortgage a lot of customers off from those old products onto more competitive interest rates. So there's still the scope to remortgage them in the future, these plans.
If you've got a pension though, and it's paying you enough money to pay off a, whatever that is, 7,000 divided by even if it's like, I don't know, 500 or 600 quid a month, you've basically probably got enough in your mortgage to pay in your pension to pay that. I'm trying to see the downside here.
Yeah, exactly. So a lot of people now are realizing, especially, if you look at the alternative options like taking money out of assets, tax implications or, any pension pots or other assets. And it is tax free because it's on the main residence. So it does make financial sense for a lot of people, really to use, property as part of a holistic financial planning strategy. So,
right. So do some of your clients actually take, let's keep with the 150,000 and then invest that?
Yeah, investment's not something encouraged because it's what we would say an unquantifiable return. Okay.
Right.
So, there are other things, for example, gifting to family is an acceptable strategy, but investments, because we don't know what the return may be, it's a heavily regulated industry and we've got to be shown to be providing ethical advice.
Right.
But there is the drawdown facility. So instead of taking 150K, a client could take 50, for example, and have 100K in reserve, and then could take that as and when you need it. And the idea is you only charge interest on the money you've actually physically taken.
So when you pass on, even though your partner, your wife, your husband, whatever, hasn't, then basically that, what it was called, we'll keep with 150,000 is locked off the value of the 500,000.
If it's a joint property,
that's a good question. Yeah. What happens if it's joint?
It continues until the last person's passed away or gone into long-term care.
I see. Okay. So, well, the good news is that I'm probably going to go before my wife. So you get the money out. What about you, Kevin? It sounds like a really good idea.
It sounds like something to be thinking about.
Yeah, leave her with all the burden.
So you take the money. You can pay the interest or let the interest accumulate. I presume that's why the percentage is low. So there's some headroom in the property.
Yeah, precisely.
Add the interest on.
Yeah, exactly.
Can you pay the capital back? And think if people in 50s and 60s, they could still be potentially waiting for inheritance to pay off mortgage.
Yeah, you could pay back up to 10% of what you've borrowed every year, including the interest. So say 15K a year, for example.
Yeah.
So on that scenario, so you can chip away at the capital as well. So they're becoming a lot more flexible, these products.
But people want that cash for all. Well, you were really saying, Paul, that some of the uses, like investment, for instance, is not necessarily going to be allowed under a scheme that you would sort of provide. So getting a boat, handing it on to the kids, charitable donation. I won't imagine.
Charities. If there's a real reason, for doing, because some people don't have family, they might want to distribute the wealth to charity or as part of the overall strategy that might fall into that plan, and that's acceptable. Anything illegal apart from obviously investing, which we wouldn't recommend. So. Is fine. So
and it's certainly a very interesting form of tax planning, Paul. And it's a long time since I looked at the rules in this area. Is it still true that a gift, if providing you survive making the gift by 7 years, it's exempt from inheritance tax?
Correct, indeed. And the issue we're finding is it's a bit of an education gap, with a knowledge gap, really, because people remember the years ago, the equity release being a very rigid and expensive thing, where shared appreciation mortgages and there's a stigma attached to the term of equity release. So we're moving away from that term, thankfully, and funnily enough, later life lending is the term that the industry seemed to have moved towards, which we were eight years ahead with when we named the business. Because everyone's calling the industry later life,
Yeah, I have noticed that, and just doing the sort of huge amounts of research that we're well known for into our guests. That I noticed that later life was cropping up everywhere, Paul.
Yeah, what a coincidence. I mean, I came up with that with my accountant. My wife's taking credit for it now, but
well, she would do. She would do.
Yeah, exactly. So sorry, my wife came up with the name, and she's hit the nail on the head, hasn't she?
Well, and in fairness, and just if anybody's likes the sound of Paul, then and wants to get in touch, then it's later life finance.co.uk.
Yeah, we needed that to come up with the domain, you see.
Yeah, it's one of those bins of my life that you just can't get those domains unless you're going to spend a shed load. But actually, you don't really need that now. I think it's pretty clear from what you do that's how you help people. But you help people with these lifetime mortgages.
Yeah.
You also say you do retirement and wealth. Is there much in that in those other areas that you do?
Yeah, we use the wealth and the retirement. It's because it's all part of one entity, really. So it's all around the lifetime mortgage, because as we've discussed, it fits into that retirement and wealth strategy, that sphere, really, doesn't it? So
yeah. So I mean, equity release is what is it. It's the same thing, pretty much, isn't it?
Yeah, it is. I mean, you could use the term equity release for releasing money out of any property, couldn't you? Really, because that's what it is. But I think because the industry's evolved, as Kevin's rightly said there, it's totally changed over the last few years with the flexibility to pay back as well. That's a game changer.
Yeah.
So it deserves to be rebranded.
That's really weird. That's the bit that I find weird, that people make the decision that they're going to release some of the equity that they've got in their property as a later life lifetime mortgage, and then they say, "Oh, I tell you what, we'll have to pay this back." Why do you take it out in the first place for?
Exactly. You see, people want the choice to do it. Right. But especially with wealthier clients, when they look at the wider inheritance tax plan, it makes sense to have something outstanding against the property, and also the benefit of getting the money now and seeing the advantages of gifting or spending some money now while you can, we can't take it with us, unfortunately, can we? So,
and the idea that your kids are going to be spending that money without you there, that must eat into some people. So therefore, this is a good idea for them. You might as well be there, having them enjoy the money. But I
agree with you there. And you might have some, saying how it's used as well. And we go through different life stages, don't we? I mean, some people's children, call them children, but they might be currently in the 40s or 50s.
Yeah.
They might need money now for the mortgage, their own mortgage, or properties, and they might appreciate those things now rather than in 10, 20 years time when the parents have passed away.
So, well, I'm sending my three a bill because they're all doing really well, and so I'm going to be sending a bill saying, by the way, you got this. I've got a long list of things that we Christmas presents, you name it, university, all that kind of stuff. So I've added it all up, and basically that I'll be sending them a bill for a share of it, as you do from Yorkshire with a Scottish ancestry. So basically, it's one of those things. And Kevin, you'll be doing something similar, won't you? You'll be charging your kids for the upbringing they've had.
I think it's probably a good idea, and if we total that up over the years, they probably owe a small fortune.
Somehow I don't think they're going to be paying it back though. But no, seriously though, I do think that the type of clients that you're going to be talking to, generally speaking, they're going to be quite affluent.
Yeah, I've over the last 5 years, I've moved more into the private client sort of area of lending. So I deal with high net worth customers, clients of private banks, accountants, and wealth planners, really. So my goal really is to bridge that gap of understanding about the benefits of wealth preservation and distribution, really.
Yeah.
Yeah.
So if you can actually you go along with something like this, it helps, shall we say, prevent some assets that the government would rob from, because it's a pernicious tax, is the IHT. It's one of the most hated taxes. But effectively, you can stop the government from taking so much of their assets simply and by releasing that money ahead of time. But
exactly.
Do you find that the people who queue up for this have probably figured out they've got some form of, I don't know, disease, or have they said, right, it looks like my life's going to be capped within a few years, or is that not the case?
Sorry.
I mean, for instance, have they figured out that it's not the fact that they've, they know that they're in the mid-60s. It's more of a, okay, maybe they've started to get diagnoses of various diseases, etc.
What, for wanting to take some money out?
Yeah.
You do get occasionally people who have been, diagnosed, and they think, if it's a wake-up call with your health, that can spur people into thinking, I might need to enjoy the next few years rather than, not, obviously. But no, I think we saw a big change after COVID. I think people had been, obviously, we'd all been stuck inside for too long.
Mm-hmm. Yeah.
That changed, I think, people's perceptions. I mean, apparently Bentley and Rolls-Royce sold more cars than they've ever sold, in the last couple of years.
Oh, after COVID, yeah.
Yeah, well, yeah, after COVID, when everyone got out, because I think people, it was a wake-up call for a lot of people. And I think, we get people who are healthy and just looking to, we work hard all our working lives, don't we?
Yeah.
What's the point in struggling in retirement years? It doesn't make any sense.
I do know that high net worth individuals and are wealthy individuals, affluent individuals, they often have to be almost coached into believing that they have the authority to spend their own money. Sometimes it's if you've scrimped and saved and built a business, etc., you've got that money. You're probably really quite wealthy, and you've got more money than life, right, left. And but they still have to be persuaded that, hey, you can spend your own money. You mentioned a boat earlier, but is there anything of that you need to do, almost like granting them permission?
Well, I agree with that concept, actually, Graham, because you do see that it's ingrained into people who worked hard to get where they are.
Yeah.
And one of the main reasons, I mean, I had an inquiry yesterday, a chap down in Oxfordshire looking for 1.4 million to clear his existing mortgage, with a private bank. And, he said, the mortgage is actually 2.8, but I can pay that off, halfway off. So, interesting situation to be in. But, and these people aren't always looking for, like a cash injection. They might be looking for a remortgage. So that tends to be the main driver. It depends. You get that wealthier people tend to be driven by the remortgage requirement because they don't want to move. They're happy where they are. But some people might want a cash injection as well. So it just depends on the circumstances. But people are used to a certain level of lifestyle, aren't they, as well?
But you can't advise. Your FCA accreditation will only allow you to advise people in the UK. Correct.
Yeah, that's right. Yeah.
So you couldn't offer because logically the sort of range of skills and the mortgages and so forth are probably available in the United States or other English-speaking countries, but you're just not allowed to do that.
Yeah, the big in America and Australia, these products. So they call them reverse mortgages, which is quite an interesting name for them.
Yeah.
So and that's catching on over here as well now, slowly.
Oh, okay.
That name.
Okay.
And they've been quite big over there for in the States and Australia for quite a few years, and it is something that is starting to the name's starting to catch on here. So But yeah, only in the UK because the lenders here will only lend on UK-based properties.
So the lenders tend to be what, banks?
Yeah, well, more pension companies. Yeah, annuities, insurance. So we've got the names like Aviva,
right? Okay,
LV, Liverpool, Victoria, those sorts of companies.
Right. So and part of what they do for is and presumably the amount that they're lending is going up and up and up because it's obviously it's got its market presumably, or has it gone down a bit?
What the market
for this? Sorry.
Yeah, it had a good year last year. It's obviously cooled off a little bit because of what's happened with the the situation back end of last year with the mini budget.
Yeah.
I think I've been speaking to a contact at Aviva this week, and the forecast is they're expecting a busy year again because of the situation the country's in. Yeah, there's a lot of people using it to help families or themselves. Just with the general costs of living, for
is this something you would consider, Kevin?
I think potentially, yes.
I think it's
one of a very good way of making sure you've got the amount of cash available to continue with the lifestyle that you're used to.
Yeah.
I can also think of another scenario here. My mum is still alive, lives in an apartment. Okay. That particular apartment block at the moment needs some fairly severe maintenance. So we're looking at potentially replacing the windows in the entire block. And each apartment owner has to make a contribution to it.
There you go. Yeah.
Now, chances are some of these folk don't have ready cash to be able to do that. Now, this sounds like another piece of financial flexibility that will allow those folk to go in, do the repairs necessary, maintain the value of the property, and because of the way this sort of loan works, not actually have to pay anything.
That's right. Yeah, that's quite a common reason for taking funds out. So
the thing about it is your mum won't be able, that the respective amount won't come your way, or however it's going to go in a will, for instance, Kevin, because basically it's going to go LV's way, isn't it? That's the point. So your mum would take out this lifetime mortgage. She would have the money to pay for the windows, but the respective amount that she took out as a sort of what's the right word, as a sort of a death benefit to you or the family that she passes it on to, that'd be reduced by the same amount.
Correct. But at the same time, in that sort of situation, you've got to say, well, if the work isn't carried out of the property, the value of the property will reduce, and I suspect could well reduce by more than the value of the work, the cost of the work to put it right.
That's an accountant talking, Paul. So I mean, he knows.
That's exactly what I was thinking. It's true. You're enhancing. A lot of these people are taking money to maintain the homes in a good standard, really. So it makes financial sense, doesn't it, if you think about it?
It's a really good example, Kevin.
It is. Yeah.
And actually, in some ways, when you look at your mum's situation, regardless of the value of the property that she's living in, it's the remaining life. She's, in a sense, she's investing in a better quality of life for the. I mean, yes, there'll be some messing about whilst the windows are being changed, but that's a couple of days, isn't it? But the end of the day, she could come and live with you, Kevin, for a little while. But that'd work really well. But so you can see how Kevin's face changed then, as I said that. But basically, but for the rest of her natural life, she would have a better living environment.
Yeah.
I can really see the sort of attraction of this, Paul. How are you going about? I mean, presumably in your business right now, fairly small business, but how many people currently are working with you?
So my wife works with me. So Sarah looks after the web development side of it. Not being a large company, because we've been successfully trading under another broker for the last 10 years.
Sure.
So we've got myself and another advisor, Peter.
Yeah.
You know, and then the idea is not to become a huge broker. We're focused on looking after people for the long term. You know, we've got, you know, a real passion for making sure people are not left on their own. So if they take a lifetime mortgage out and they need us in a year or 5 or 10, we'll still be here to look after them. And it's really something we, you know, we really want to harness and take with us on the journey, you know, for the business, you know, that people feel that, you know, that it's quite rare nowadays, isn't it, for companies to offer that level of, you know, service. And, you know, it's something that we, you know, we're very passionate about. So.
And well, that'll keep your customers, won't it? So, and you know, for those people who think that Yorkshire's really sort of I don't know, some sort of slag heap or whatever. I mean, the point is where Paul is in terms of his location is kind of slap bang in the middle of what we call the Golden Triangle. And, you know, you sort of go out towards Ilkley and then up towards Harrogate and then down to Leeds and so forth, North Leeds. You know, a very, very wealthy set of people. We talked earlier last week, Kevin, to somebody who was in the sort of affluent area of South Birmingham. You know, and that's a very wealthy area. But, you know, there are always pockets of wealth, and you're right in the slap bang in the middle of it. So you won't have to travel far to find your clients.
That's right. I've got good connections with Harrogate, and I've got, you know, clients all over the place, you know, all over the country. But yeah, you know, the focus for the business is, you know, to build the knowledge locally with these people, so they're aware of the benefits. Because, you know, we've had a really good conversation, and you can see, you know, when you speak to people and they understand how it works, they do ask the same question, Graham. You know, for want of a better term, what, you know, it's a no-brainer, really, isn't it?
Well, it seems that way. And there's part of me that says, I've got to resist this. I've got to resist this. I don't want those insurance companies to have one more pound of my money. But actually, it is your money. And they're just facilitating that. And yes, there is a cost of doing that. But the fact that you can repay some of this over time, and did you say 10% a year, Paul? So basically, that's
you can pay 10% a year. You can set up a monthly automated standing order to maintain the interest payments, or over. So you could divide the 10% by 12 and pay that. You can move, you can pay it back when you move, you can move and port it with you to another house or another property. It's just like a normal mortgage. They're starting to mirror the mortgages that they've been designed to repay, which is the, you know, the interest only mortgages. So, you know, people want flexibility. Years ago, they weren't flexible. And that's, you know, they didn't have a good reputation because they were rigid. It was compound interest. You didn't have much choice in the matter because, you know, there was only one interest only mortgage available, and it wasn't flexible. But now they're all offering voluntary repayments. You know, you've got the Equity Release Council, so we're a member of the council, and they carry several codes of conduct.
Was it challenging for you to become FCA accredited to do this sort of work? I mean, you said you did it a year ago, but you've been doing this for some time now.
Yeah, the process was lengthy because of the, you know, the processes with the FCA were you know, prolonged, and they have a huge backlog. So once we got into the process, it was fairly straightforward. You know, so it's quite a big achievement, you know, that we're proud of.
Wasn't exams and things that you had to do that way? It wasn't like you had to take of exams. But did you have to sort of prove your credentials?
Yeah, I had to send all my credentials off. So I did the exams many years ago, but they want to see that the business model's viable. So they take a lot of interest in that. So you've got to be fully, obviously you've got to have full insurance as well. They need to understand that your compliance is, you know, really transparent and rigid. And they want to make sure that everything that you're doing, you know, is accountable. So especially with something of, you know, an area of advice like this, it's important, isn't it? So it's good.
You don't want to be getting that wrong, because it's people at that time of life, they don't get a second chance, do they? You've got to get it right pretty much first time.
Agreed. And the industry is under the spotlight because of the volume of cases that have been written over the last few years has really risen because of the demand. And that's good because it maintains very high standards. So rather than being a big broker with lots of advisors, we want to focus on high net worth clients who want a certain level of service. If if they ring, we pick up the phone and we help them. It's not being
I think Paul, that I actually serve clients with high net worth individual data, etc. And the point that you're making on your website is that a lot of these people are exactly as I see them as well, which is exactly asset rich. So maybe properties and lots of other investments, but actually the cash just isn't there. And sometimes some of my clients come along and say, "Oh, they've got to be earning over X and X, Y." Well, they're not often. They're not earning huge incomes, but they've got huge wealth.
Yeah, exactly. I arranged a remortgage for another private banking client last year in Leeds on Ling Lane, which is one of the best streets in the country. Yeah. And he's a retired accountant. He's still looking after people, and he's got, like Kevin, he's got that mindset, and it's just fantastic, when you speak to accountants. I do look after a lot of accountants, still working, some retired, some not, and they just see it. They get the principles of it. Yeah, it makes financial sense.
Well, yeah, I mean, Kevin, I keep saying he's an accountant, but he's more of a management consultant. But basically, having said that, you deal with an awful lot of financial directors and so forth, Kevin. Do you think they would get this story?
Oh, they definitely get this story. Yeah, yeah. Anybody with a decent financial mind will get this story. And this is one of those things. It's right for some people. It's not right for others.
The more astute and successful people are, the more they see the advantages of it.
Yeah. So it's if Kevin's point's also right, that there are some people it's not right for. If you get one of those clients in front of you, and because of the way in which you've already set out your store, you wouldn't be taking them forward. You'd be saying, actually, for these reasons, I don't think you're right for it. What would they be?
So clients with ready assets that they could utilize instead, right. So if we've got somebody with sufficient savings and, they're not got any plans for those savings, and we could have a conversation about waiting a few years and reconsidering again in the future. There's lots of different scenarios where it just wouldn't be suitable, where you might have somebody who is in a large property and they don't need it.
Yeah,
they're happy to downsize.
Yeah,
so take that route, downsize, take some money out of the equity from downsizing instead. So it's important, and it's part of the advice process we follow to look at all these alternatives. And some clients might be eligible for means tested benefits, and we go through that as well as part of the process. It's not all wealthy clients are eligible, obviously, but it's something that it's an advice process we follow to ensure that suitability.
Yeah. That makes a lot of sense. So you work with your wife. What on earth is that like?
It's interesting, but we've got 3 young children, so she's kept on the ball with those as well. So
yeah. So you don't see her every day in the office?
No, we managed to have some quiet time.
Good. But the kids, I mean, how old are your children?
So we've got Grace, who's 13.
Right.
Harry's 9, and George is nearly 4. So
it's just a nice range. Yeah.
Nice range. Interesting. Keeps us busy.
Wow. Paul, it's been an absolute pleasure having you on the Next 100 Days podcast.
Well, Graham, some interesting learning there. And I'd never really known what was possible around later life mortgages. I knew that they were possible to have, and I knew that they were an interesting tax planning tool, but it's good to get a few extra facts.
I think quite a number of our listeners will be slightly older, slightly, I'll be honest with you, slightly more affluent. And effectively, we will, not all of them, but some of them. And, even the ones that aren't would find, I think, that quite interesting. If it's not for them, for other people. One of the beauties of this is that it was explained in such a straightforward and simple way. You understand the reason that people do this.
Absolutely, yes.
I think your example as well was really well thought through in terms of your mum's property.
And I can think of several examples. I mean, example number one that we talked about a fair bit is that you've got an interest-only mortgage that's coming to the end of its life, and the provisions that you made to pay it off aren't going to pay it off.
Right.
Number two is you simply have an inheritance tax problem and you need to release some money and gift it early to avoid the tax.
Yeah.
Situation number three is you seriously need some cash.
It could be things like, that I've got this Tesla, and at the end of its period, there's a balloon payment to find. Now, that shouldn't be beyond us, but the end of, and I wouldn't imagine we would need one of these loans for that reason. But it's another call on your cash.
Well, it is.
And it's one of those things that
Tesla is, you go back and get another one. You take another PCP grant.
Well, that will be the plan, and probably earlier than we would have imagined. Having said that, because the prices have been reduced a little bit, so it's taken away some of our equity on that basis. But nonetheless, that's something that we're thinking about. Today, it's been a great podcast with Paul Murphy from Later Life Finance, and you can get him on later-life-finance.co.uk, where he's got his wife's obviously done the website, as he mentioned, and it looks really good. And I think they can hopefully attract a few more clients because of this podcast.
Well, let's hope so.
Well, today I've been Graham Arrowsmith.
I've been Kevin Appleby. Goodbye.
Goodbye.